Put option selling often feels like easy rent collection until the market knocks at your door with an eviction notice. Hi, I am Pranav VK, an NISM-certified trader and trainer, and your options trading guide here at Stockshaala by Kotak Securities. In the last video, we learned how we can buy put options and make profits from a falling market. Today, we are going to cover the flip side, that is put option selling, often sold as easy money, but is it really? When you sell a put option, you are giving someone else the right to sell a specific stock at a specific price. In return, you are collecting a premium upfront. If the stock doesn't fall below the specified strike price, then you get to keep the premium. But if the stock price falls, then you are obligated to buy that stock at the agreed price. So basically, you're going to have the income if the stock stays flat or goes above the strike price. But if it goes below the strike price, then you're in for a loss. Let me help you understand with a real market example so that you understand this concept better. Now let's take an example of stock ABC, which is right now trading at 1500 rupees. And I would like to enter a put option sell contract with a strike price of 1480 and premium of rupees 30. Now since this is an option selling contract, I will be receiving this premium at the end of the transaction. Now there are two scenarios that is possible. In the first scenario, the price of the ABC stock can go higher, whereas in the second scenario, there are two parts. In the first part, the price of the ABC stock might remain flat, or in the second part, the price of the ABC stock might go down. So let's understand the profit and loss in each of these scenarios. Now let's discuss the first scenario. In the first scenario, remember that the ABC stock is at 1500 and it might go higher than that. In this case, the strike price that we have is 1480. So if the price of ABC is staying above 1480, in that case, this entire premium is going to become worthless, which means I'm going to receive the entire premium of rupees 30, which means this is the profit of rupees 30. In the second scenario, let's discuss the part where the price of ABC stock is going to remain flat. In this case also, the premium is going to become worthless, which means I'm going to receive the entire premium of rupees 30. In the final scenario, let's consider that the ABC stock price is going from 1500 rupees to 1450 rupees. In this case, you're going to start making losses. But the more the price falls, the higher your losses are going to mount up. And as you can remember, as an option seller, you have unlimited loss potential and limited profit potential. But the beauty is that you have to remember that the probability of profit of option selling is 66%, whereas the probability of profit for option buying is only 33%. Now let's discuss the risk of put option selling. People say that 90% of all the contracts expire worthless. But you have to remember that one big move can wipe out all your profits and even bad your entire capital. Here are some of the risks of put option selling. Number 1, stocks crashing due to bad news. Number 2, huge gap downs due to overnight positions or because of geopolitical reasons. Number 3, not putting stop losses while you're trading because you're obligated to buy. And finally, remember that because it is put option selling, you need quite a bit of margin as well as proper risk management. Here is an amazing fact about put options. Did you know that the Chicago Board of Options Exchange was launched in 1973? But put options was only introduced much later because the risks involved was much higher for retail traders. Even globally, put options are considered very risky at first. So when exactly should you sell put options? Let's discuss. You can sell a put option when your view is bullish or sideways on a specific stock. You can also sell it when you want to own a stock at a lower price. And finally, when the volatility is high, because higher the volatility equals higher the premium. So now let's discuss the key metrics to track when you're doing put option selling. The key metrics are the premium received, the break-even point, which is strike price minus the premium, the margin required, as well as the maximum risk on your position. Let's do a quick recap of what we have learned so far. We understood that put option selling has to be done when you're bullish or sideways on a specific stock or an index. Put option selling has unlimited loss potential, whereas limited profit potential. But the point to remember is that the probability of profit is much higher at 66%, whereas the probability of profit for option buying is only 33%. The risk of put option selling is extremely high during crashes or during overnight gap downs. And finally, don't try to do put option selling without understanding margin requirements, the maximum risk potential, as well as the profit potential. Put option selling may look safe, but remember that you're selling insurance in a world full of surprises. If you like this video, go ahead and share it with your friends. And remember that call option selling and put option selling always have higher probability of profit, whereas put option buying and call option buying always have lower probability of profit. Probability is always greater than profits. So always give more importance to probabilities. You're watching Stockshaala by Kotak Securities. I am Pranav VK and I'm gonna see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.